From our Cyprus office. We're overlooking the mountains over Paphos and considering what the impacts and the deeper potential of the Cyprus tax changes for 2026 mean. We'll also cover generally other big changes that are going on in this world. With in July 2025, the EU's blue card scheme is being introduced, which is a preview to the Schengen zone and the electronic visas being introduced in 2026 as well. So the EU blue card scheme gives an EU-wide avenue for people to be living and working abroad in all EU countries, including Cyprus, and what those options might be compared to where you are at the moment. So have a look around, follow us on YouTube and our Living and Working Abroad channels, Facebook, X, and LinkedIn, as well as our website at partnership.com. And you can contact us at our website to have a free review or consultation about living and working abroad, whether you're moving out of the EU or into the EU to or from the UK. So today's main feature, we're looking at Cyprus tax changes and what the impact is going to be there for people. And is Cyprus a reliable place to be a tax resident, to uproot your life, your business, your family, your property as a tax destination? Many jurisdictions around the world have got a big rep. You could go to Dubai and pay no tax, but you could also be paying a lot of rent, and require a lot of income to get in, because you do need a residency permit to live in those countries. Yes, they extend it to beyond people that are working abroad, but you need the sponsors, and it's a different type of regime. So for Cyprus, it's an EU destination, it's a Mediterranean destination, and what are the reasons why you might consider that? Tax organisation around the world is centred, and policy comes from the OECD, which is based in Paris. And they for years have been pushing the exchange of information among international governments, and been pushing to change the tax rates that are allowed. The OECD is the basis structure of all the double taxation treaties around the world. Each individual country that has a double taxation treaty, they can amend it to suit their needs, but the basic template comes from OECD agreements. A double taxation treaty, when you relocate abroad, doesn't mean that you're going to pay twice the amount of tax. What it means is you're not taxed twice. You're not double taxed twice, okay? And this is for tax, so income, capital gains, and inheritance taxes. It's not for national insurance. If you want to talk about social insurance agreements, something completely different, still affects working people. So it comes into our tax webinars and blogs, but do look out for our separate blogs where we consider social insurance agreements around the world. To be a tax resident and work, you do need a work permit, which is why the extension of an EU-wide blue card scheme could be of interest to non-EU expats who are looking to relocate abroad, which of course at the moment includes the UK. When you take a country like the UK, they're tax hungry. They're looking to charge you tax. They want your income tax up to 45%, your corporation tax up to 25%, inheritance tax of 40%. They're now taxing you everything, including your pension funds, dividends up to 39%, capital gains up to 24%. So they're taxing working people, their businesses, their investments, their savings, their pensions. And those can all be mitigated and reduced if you relocate abroad to a separate jurisdiction. But the OECD has introduced minimum tax rates around the world, and a country has to comply with that to fit in with the international order and scheme of things. And those changes are enforcing this revision in Cyprus. Earlier this year, in 2025, Malta lost a case brought by the EU against their tax schemes and said that they didn't fit in with international tax policy and they had to change them. And so, in part, Cyprus is reacting to that to anticipate and improve its tax offering for people living and working abroad. Not the same as other countries, but let's look at what that means, what it means to be a tax jurisdiction. The EU controls many things, but it doesn't control taxes. Yes, the EU has got its own little tax called VAT, so it's a sales tax that generates revenue for the EU. Even though the UK has done Brexit, they've still retained their own sales tax, but many countries around the world do. Um, uh, but it doesn't directly impact on tax residency. It has an influence through the various councils. Ireland and Cyprus in the EU have had 12.5% corporation tax rates for many years, making them an attractive low tax destination for companies and for holding companies. Um, but the OECD has wanted for a few years now a 15% minimum corporation tax rate around the world. Now, if a country doesn't conform with the international rules, then they get put on an OECD blacklist. The worst form is the blacklist of jurisdictions that will include states at the moment like Iran and Russia that are causing conflicts around the world. But it can also be for not charging tax, or if there's perceived to be no tax compliance in the way that they apply residency tax rules in any country. So a country doesn't want to get on a blacklist jurisdiction. It also now there's a low tax jurisdiction because countries like Romania, Estonia, Cyprus, Malta try to offer lower tax rates for expats living and working abroad, as do Isle of Man, Jersey, Guernsey, and Gibraltar. But of course, the international community doesn't want that. They want everybody to pay their fair amount of tax, and the big countries want everybody not to lose all their tax business abroad because somebody goes to somewhere where they're not paying tax. So there's a convention in this, and there's a set of rules that we need to follow, and we have to pay. We follow the tax rules and pay the minimum tax and maximum tax savings following the rules, not going to a country which is uh, classed as a blacklisted state, where in effect um, the the impact of a blacklisted state is not going to have any double taxation treaties, or they're not going to be working. If you're a British tax resident and you go to live in another jurisdiction and there's no double taxation treaty with the UK, then the UK can still charge you tax on that worldwide income. If you're a British citizen and you leave the UK, you don't follow the rules over 5, 7, 12 years, then potentially the UK can retrospectively tax you on your worldwide income for that period. That is their right and their obligation for you as a citizen of that country. And things like inheritance tax will follow you around all your life. So you're looking as an expat to be living in a country with an accepted tax regime where the double taxation treaty works. Paraguay, for example, offer expat residents, and you don't need to go there, you don't need to stay there, you just need to be registered there, pay them some money, and you can pay no tax in Paraguay. But there's no double taxation treaty with the UK, and therefore you're potentially liable to tax on your worldwide income, even though you're legally resident in Paraguay, whether you visit there or not. So these are considerations that you have to think about. A double taxation treaty doesn't work if your country is on a blacklist state. And for me, I'm not happy that they introduced this low tax jurisdiction rules, and that's trying to get the Caribbean states and states like Estonia, Cyprus, and Malta up to their minimum levels, mainly for corporation tax rates. where they want them to be at 15%. So what did the UK do when the OECD announced its minimum corporation tax rate, which it aspired all its conforming countries to move to? Well, in the Jeremy Hunt budget, he raised the corporation tax rate from 19 to 25%. So apparently a low tax government introduced a massive majority to free Britain post-Brexit actually chose to increase corporation tax rates to 25% rather than maintaining them at 19 or reduce them to the minimum at 15%. And what the Jeremy Hunt budget also did was freeze personal allowances. And so there's a tax creep for people in the UK as tax goes up and up and up. So let's have a look at what Cyprus has done in response to the OECD exchange of information requirements and low tax jurisdiction requirements. So to avoid being classed as a low tax or blacklisted jurisdiction, and that sort of challenge to Cyprus. Cyprus is adjusting their corporation tax, their tax rates. The first thing that they've done is they've introduced into Cyprus legislation in 2025 a definition of a low tax jurisdiction and a blacklisted jurisdiction. So now, if you come to Cyprus and you apply for tax residency, and you've got an association with your business or your trust or your investments with a blacklisted or a low tax jurisdiction as defined by the OECD, then a double taxation treaty with Cyprus will not work for you, and it won't help with that cross-border planning. So the first requirement in the changes by the OECD to conform to international standards and not be deemed a low tax jurisdiction for Cyprus is to introduce those definition of low tax jurisdiction and blacklisted jurisdictions into Cyprus law, which is in place already by the middle of 2025. More importantly, let's look at the Cyprus Second Act that it's doing. Now, it's in process. They've made the announcement in January this year of what their intention is, and it's been agreed and debated through the initial stages in Parliament. It's been processed to be finalised and ratified by the end of 2025 to take effect from the 1st of January 2026. Cyprus don't change their tax laws very often. They did in 2019, they did in 2015. They don't do it very often. So it is a significant change, but it's also, there's a lot of consistency in Cyprus, which you can be confident in if you're an expat relocating your family, your business, or your investment assets to Cyprus. So let's have a look. And this is just a brief list. If you want more information and guidance, contact us at productpartnership.com for a free review and consultation to new clients. Any retained client from £30 a month can get access to advice and information from the Proact team. So here's a summary, okay? This is what Cyprus have done as opposed to what Jeremy Hunt did in the UK budget in response to the OECD requirements. And first of all, they've increased the personal allowances. They've increased the personal allowances. So from 2006, possibly retrospectively, some of these remember for 2025, people won't know that until December of this year. So they've increased the personal allowances. So you're able to earn more before you pay tax. A UK expat will be able to, any expat will be able to earn over €20,000 before paying any income tax, which is about £17,000. They've also increased the tax bands. So to get to the highest tax rate in Cyprus, you need to earn more money first. So the tax bands are going up, not frozen, not static, no tax creep there. The maximum tax that you're paying in Cyprus is 35%, not 40 like the UK, 35, and that is on over £70,000. So in the UK, you're on 40% over £50,000. In Cyprus, over 70,000 earnings is when you start to get the 35% tax. I've said that wrong because when I say it's £70,000 of earnings, that's pounds. That's after your personal allowance. So actually, in fact, you can earn 100,000 in Cyprus before you start paying 35% tax, €100,000 before you start paying the 30% tax, which is about £87,000 before you pay 35% in Cyprus. So increased personal tax bands, no tax for the first 18,000, and then significant tax bands, but it doesn't go up to the 40% that you might get in the UK as the individual tax rate. But in Cyprus, dividends and savings taxes are taxed differently. Okay, so and there's two rates. If you're an expat and non-dom to Cyprus, dividends and savings tax remain 0%. If you're non-dom expat in Cyprus, dividend and savings taxes are 0%. But even if you become domiciled in Cyprus, which could take a long time, it can take 10, 20 years. Even if you become domiciled in Cyprus, or if you're a Cypriot returning to Cyprus and you're deemed domicile, um, the dividend tax rate and the savings interest tax rate is being reduced to 5%, not 39% top rate as you get in the UK, 5% tax on dividends and the savings interest. The pension tax rate is retained, remains the same. If you're an expat with a pension from abroad, your tax rate is 5% and it's a flat rate. If you're an expat in Cyprus and you're receiving an overseas pension, retired to Cyprus, you pay 5% tax rate on that. For the avoidance of doubt, Cyprus is retaining the 183-day tax rule. So if you stay in Cyprus for 183 days or more, then you're deemed tax resident for that year. So that's great for somebody who wants to travel around the world. As long as you spend 6 months and a day in the year in Cyprus, then you're deemed to be tax resident, even if you spend the other 6 months of the year abroad. So that can be traveling and visiting, or it can be traveling and working in different locations for shorter periods of time. Cyprus has had a bit of a controversial 60-day tax rule, and that's changed and varied over the years. It's been challenged, but they've actually not just retaining it, but they're doubling down on it and reinforcing the rules. So you can actually be in the country for 60 days a year in Cyprus and be a tax resident. Now, what's that? That's specifically aimed at people who might have a long-term contract to work in Middle East, Asia, or Africa, or have a job that's moving them around. So your family can be based in Cyprus. You only have to be there for 60 days a year to be deemed to be a Cyprus tax resident. They still keep their remittance basis. So if you're on the 60-day rule or the 183 days rule, and you are working abroad and you haven't got remitted income into Cyprus, that is not taxed. That is not taxed. That doesn't change either. Retaining that there's no capital gains tax on investments and business assets in Cyprus. There's no capital gains tax at all. It doesn't exist. There is a capital gains tax on Cyprus real estate. So if you buy property or land in Cyprus and you sell it on, then yes, there is a capital gains tax of 20%. There's a once-off lifetime allowance of 85,000 on the sale of your first real estate. But other than that, there is no capital gains tax in Cyprus. Retained, no inheritance tax. Not 40%, not 20%, not any percent, 0% inheritance tax. So if your affairs are based in Cyprus, there is no inheritance tax charge. Now, inheritance tax in the UK charged on a domicile basis, and they've worked hard to tie in expats who might leave the UK into that inheritance tax rule for longer. But actually, the bonus side of that is that as an expat from the UK, you can actually now lose your domicile and become completely domiciled in Cyprus. But even so, there's other ways that you and your family can hold property, business, and investment assets in Cyprus and avoid the scrutiny of an inheritance tax return to pay tax of 40%. Cyprus has retained its health tax and not increased the rate. So it's got what they call a health tax, which is 2.65%. It is their version of a health tax, and that is retained, and that is there. Corporation tax is the only thing that rises. There's no personal allowance on your net profit, but the corporation tax rises from 12.5% to 15%. So they're retaining it as the minimum around the world. And that is the only tax increase that they're proposing for the new year. Everything that they're doing and proposing to meet and conform with the latest EU and OECD tax rules to be a tax compliant, stable international jurisdiction is to bring in a minimum corporation tax rule tax rate of 15%. So Cyprus is protecting and strengthening its position as an EU country as a low tax jurisdiction for family, business and investments, which is completely OECD tax compliant. It's not a blacklisted jurisdiction, not a low tax jurisdiction. It meets the minimum tax rules set out, and this is a clear statement by Cyprus that it will continue to be a stable, long-term jurisdiction for people to live in. There are no double standards on Cyprus tax. It's a stable, long-term commitment that expats can relocate to Cyprus with confidence in a stable, low-tax environment for a significant period of time. If you want to join us at Project Partnership, you can contact us at projectpartnership.com. We offer free reviews and guidance to people living and working abroad. And with the EU Blues card scheme coming in, which allows for remote working in Cyprus, along with other changes that are going on residency permits, it gives a lot of opportunities for expats relocating to Cyprus to be in a Mediterranean country with low tax and confidence and stability in the future. For more information and guidance, contact us at projectpartnership.com and follow us again next time for more on the Living and Working Abroad show.